So in my example here, you have under profitability ratio, you have gross profit margin, operating profit margin, net profit, return on asset, return on equity. So gross profit margin, John is better. Operating profit margin, John is better. Net profit margin, Barbara is better. Return on asset, Barbara is better. Return on equity, Barbara is better. Okay, so this is what you need to do when you calculate your ratio and when you want to decide. So in terms of profitability, joint company is doing better in 2 of 5 ratio here that we calculate. Barbara is doing better in 3 of 5 ratio here. So for me, okay, personally, myself, I will say Barbara is better than joint. Okay, so let's see what you have in your explanation. So as compared to Barbara, John Berhad efficiently control the operating cost incurred. Okay, because operating profit margin is higher. However, okay, here also we can add operating cost and cost of goods sold. Why did I say cost of goods sold? Because from sales to get the gross profit, we have cost of goods sold in between. Okay, so that's why the gross profit is higher than Barbara. So here John makes 39.7 cents of gross profit from 1 ringgit of sale, but Barbara only make 33 cents from 1 ringgit of sale. So John is better in controlling their cost of goods sold. However, not as good as total cost. So total cost, we are talking about the net profit margin. To get the net profit, we will have to minus, okay, from the gross profit, we will have to minus all the costs first before we get the net profit margin. Okay, so ROA and ROE are relatively low. Okay, and mainly due to productivity problems. So Barbara, as you can see here, from every 1 ringgit invested in asset, Barbara can generate 9 cents of profit, and from every 1 ringgit invested in equity, Barbara can make higher net profit. Okay, so it means from here, okay, so Barbara is doing better in managing their asset and equity to help them to generate profit as compared to joint. That's what we can see. Okay, so this is basically how you will do it in your presentation. So next we will go to liquidity. So here joint is better in current ratio, but Barbara is better in quick ratio. So as referred to the current ratio above, it appears that John Berhad is more liquid. Okay, able to pay a short-term liability. However, the quick ratio result indicates that John Berhad might face a high level of inventory issues. Okay, so here, okay, you can see that for the current ratio, it's higher than Barbara. But then when we calculate the, what do we call it, quick ratio, it is lower than Barbara. Okay, so what can you tell here? In quick ratio, we have inventory, but when we take out the inventory, suddenly it's lower. Okay, so I will put the explanation here. So when you calculate current ratio, inventory is included. But when you calculate the ratio, you take out the inventory. Okay. So when you take out the inventory, suddenly John's ratio is lower than Barbara. So what can we tell here is John is not good in managing their inventory, or John has high level of inventory, which is not really safe, because in in the event of liquidation, inventory is not liquid asset. You cannot force people to buy your inventory, and it is not making cash very quickly. Okay, so that's why we have here joint might face a high level of inventory issues. Okay, so joint is not really good in managing their inventories. That's why it is higher. Okay. Okay, next. Next, we have capital structure ratio. For the capital structure, debt ratio, joint is lower. Okay, the lower the better. Debt ratio, remember, joint is also lower. Okay, times interest and Barbara is higher. Okay, so both companies have a similar debt ratio in their capital. Okay, more or less similar. Okay, John Berhad might not be able to cover the interest payment as compared to Barbara Berhad. Okay, so the time interest earned for John Berhad is lower, but it's still okay basically. But if you want to compare, Barbara is better. Okay, but then if you look at all the bigger picture, okay, John Berhad is less risky because John Berhad only used 33% of liability to purchase the asset, and John Berhad only has 48% of liability in their financing as compared to equity. But then it's more or less similar. Okay, only 1% difference. Okay, so here your decision is really subjective. Okay, so it depends on which one. If you see, if you really want to be safe, maybe you want to choose joint, even though the time interest and it's not really good, but it's still okay. Okay, but if you are really concerned about the interest payment, maybe you want to choose Barbara, because the debt ratio and debt to equity ratio is not really difference between these two. Okay, so next one we have efficiency. So for inventory turnover, you have Barbara 3 times in a year, John Berhad 1.4 times. Okay, and then account receivable days, so Barbara takes only 90 days to collect back the, what do we call it, account receivable, the debtors, and John Berhad took longer. Account payables also, Barbara took 44 days only to pay back the account payable, but John Berhad took longer. Okay, so in this thing here, for the efficiency ratio, we can say that Barbara is doing better. So John Berhad collection of debt period is longer than Barbara. Okay, John Berhad might need to revise the collection policy. So John Berhad took much longer than Barbara to pay its creditor, since they did not have sufficient cash. Okay, it may be due to lower demand of their product. So you can see here also your inventory turnover for John Berhad is slower. Okay, so we can use that as our reason. Okay, so John Berhad inventories are being sold more slowly than Barbara. Thus, this indicates the inventory level is too high, so lower demand of products. Okay, so you can say that John Berhad might need to revise their marketing strategy. Okay. Okay. So that's what we can say from here. Okay, and then, okay, so previously in the previous slide, from slide 33, 34, 35 until 36, we are comparing between two companies. Okay, so if you look at slide number 37, we are comparing between two different years for one company only. Okay, so how you want to analyze the company, the same company, if you want to look at whether you perform better or not between throughout the years of your operation. Okay, so if you look at this one, we provide you with shareholders ratio. Okay, you have dividend yield 5.2% in 2010, earnings per share 1.62 in 2011, price earnings ratio 12 times. Okay, so the dividend yield declined slightly from 5.2% to 5%. This decline was primarily due to increase in the market price of John Corporation common stock. Okay, so that's what you can say. So John earnings per share on ordinary shares improved from 1.5 to 1.62 during 2011. This represents an 8% increase over 2010. Okay, so increase is good lah. And then John PE ratio improved from 10 to 12 during 2011. So we say it is improved because the higher the shareholders willing to pay for your shares, the better. Okay, even though you give them lower dividend or lower EPS, so the higher people want to pay, the better, because the higher means your company is doing good in terms of words of mouth. Okay, so people are talking about good things about your company. That's why your market price of shares increase, spike up. Okay, so it means that from 2010, people are willing to pay 10 times higher than EPF to purchase your shares. By 2011, people are willing to pay 12 times higher than your EPS. Okay, so this indicates that the market expect John Berhad to experience favorable earnings in the future. Okay, so like I said just now, speculation can be the reason why people are willing to pay higher to purchase your shares. But then here, okay, if you look at here, you can use earnings per share as your reason as well. Okay, maybe it's also because John Corporation is doing better in terms of earnings per share as compared to the previous year. It can also be the reason why your earnings per share, the price earnings ratio increase. Okay, so that's what you can do if you were to compare the same company and it is throughout the years of operation, between the year of operation. Okay, next I will cover on the gearing. Okay, so gearing means your commitment. Okay, how high your liability is. Okay, so high gearing means high commitment. All right, so high gearing company means that company is having a lot of liability, a lot of long-term loan. Okay, and lower commitment to dividend payment. So like I said just now, which slide just now? Okay, this slide just now. Okay, you have two ways to finance your business again. Okay, it's from liability or equity. Okay, so of course, if you are a high gearing company, means you are having a lot of liability. Okay, it means liability comes first. Okay, if you have excess cash and whatsoever, you will have to use that cash first to cover your liability. Okay, after that, then you can focus on giving the dividend to your shareholders because you have to save yourself first. All right, so because if you fail to pay your liability, because it's fixed, right? Your liability is fixed, the payment is fixed, you will have to pay the interest on loan fixed every year. So any failure to pay the interest on loan, okay, might risk your position. So going back to this one, gearing. So high gearing company will have high commitment on payment of interest on loan, and at the same time, because of that, it will have lower commitment to dividend. So we are talking about this one also. We talk about what type of investor you are. Okay, if you are the investors that are not looking for a company that have high gearing, then you will not choose this company to invest. Okay, but most investors believe when the company is high risk, they can get higher return. Okay, so if you are this kind of investor, you might want to go to high gearing company, and you are not you don't really care about not getting the dividend now. Maybe you are looking forward to 1 or 2 or 3 years later, and you expect to get higher dividend later, even though the company is having high gearing now. Okay, so this one is depending on what type of investor you are. I am not really familiar with investing. Okay, high risk, high return. Maybe you can try to ask your finance lecturer. Okay, maybe. Okay, so low gearing means low commitment. So if that company is said to be a low gearing company, means that company is not having much liability. Okay, so if you are risk averse investors, okay, if you are an investor that is concerned about more dividend than more paying of commitment, the interest on loan, you will go to this kind of company. Okay, so how to reduce gearing? Okay, so how to reduce high commitment or high loan? Okay, the company can issue more ordinary shares than depending on the long-term loan. So like I said, when you finance your business, you have two ways: issue shares or getting the long-term loan or issue debenture. So instead of getting the long-term loan or issue debentures, you might want to issue the ordinary shares. Okay, so it is lower risk. Or redeem debenture or preference of shares. So redeem also talks about purchasing back or buying back preference shares. Okay, so if debenture, redeem means pay back the debenture. Okay, but of course, if you want to buy back your preference share and if you want to pay back the debenture, you need cash a lot as well. Okay, so preference shares is one type of share, but it is not equity, it is liability, because preference shares you have the obligation to purchase back later. Okay, so when I say obligation, it means it is a must. You cannot avoid. Okay, so that's why preference shares cannot be put under equity. It is a liability. Okay, don't worry, later we will learn about preference shares. Okay, or how to reduce gearing: increase your retained profit. Okay, reduce your interest payment. Okay. Okay, so next we will go to trend analysis. Trend analysis we can do to the same company or different company. Okay, so here you have G and H, two companies, and throughout the years of operation. So here we want to look at throughout these 5 years of operation, how these two companies is doing. Okay, so we provide you with gross profit margin, net profit margin, ROCE, and current ratio. So with all of this that it is calculated for you. How to do trend analysis? Plot the graph. Okay, so this graph is generated from whatever that you have calculated here. So you can say company G gross profit is higher for the first year as compared to company H, but throughout the year the gross profit margin decreases. Okay, and for the company H, even though year 1 the gross profit is lower than company G, but throughout the 5 years it is increasing. Okay, so if you are talking about, if you ask me, okay, I will say that company H is doing better because it is improving. Okay, they are managing their cost of sales, improving throughout the year. So for the net profit to sales, okay, so you can plot like this. Okay, so you can say that net profit of company G for year 1 is okay, still higher than company H, but then throughout the year the net profit decrease. Okay, and for company H for 1, 2, and year 3, it is the same, but it keeps increasing. Okay, and if you ask me, I think I prefer company H. Okay, so you will do the same for all of this ratio. So that's what we call as trend analysis. So trend analysis is to look at the performance of company throughout the years of operation. So it depends lah. If you want to see for 5 years, then you plot for 5 years. If you want to see for 10 years, then you plot for 10 years. Okay, plotting like this, you can see better. Okay, so from your trend analysis just now, what can you say? Company G appears to be the worst investment because you can see from the graph, okay, the graph for company G is, okay, going down and going down for all of the ratio. So it could be the worst investment for the future, okay, as the trend is moving downwards. Company H is strengthening its position all the time, okay, because you can see company H, even though this one, you can see it drops a bit, but it increased back, okay, and for all other ratio as well, okay, the graph keeps increasing, okay. So that is what it means by trend analysis. Okay, so next and last, financial ratio limitation. Okay, so of course, when you want to evaluate a company, the company's performance, you can use the financial ratio analysis, but then they have the limitation because financial ratio analysis, we use the past performance. So past performance does not necessarily mean it will reflect the next year's performance. Okay, that is what I talk about historical data. Okay, and then, okay, first one, you have different accounting practices, economic situation, policy and management system, marketing strategy, and etc. So different companies have different accounting practice. Okay, for example, your total net asset of company A and company B might be different because of the different method of depreciation. Okay, so company A might use the reducing balance method for their office equipment. Company B might use the straight line method. So straight line method will give you higher non-current asset net book value. Okay, because the straight line method depreciation is constant every year. But then for reducing balance method, it keeps it makes your net book value keeps decreasing every year. So it will give you lower net book value. So because of different accounting practice, okay, different company might give you different result. So that's the limitation of using the financial ratio analysis. Yes, we can depend on that, but it doesn't give you 100% of true picture of the company. Okay. So historical data, that's the one I have already mentioned just now, because when we use the financial statement, we are depending on whatever that has already happened in the past. Okay, for example, you are analyzing the financial statement of a company in 2019. Okay, 2019, we don't have COVID-19 yet. We have COVID-19 at the end of 2019, but in 2020, everybody went for lockdown and everybody are affected. So if you want to use whatever performance in 2019 as your basis to decide to invest, it is not really accurate, right? Because 2019, your company might be doing so good, but during the lockdown, the 2020, everyone is not doing good. So if you want to depend on past performance to make the decision for the future, it is not really 100% accurate, okay, but still you can use it, okay. You have certain limitation because of that. The past cannot reflect the future, okay. So next one, single ratio. So single ratio means if one ratio is good, okay, it doesn't mean that another ratio can be good. Okay, for example, your current ratio is good, but then your return on asset is not good. Your shareholders ratio is not good. So one single ratio is not enough for you to decide or to make a decision about performance of a company, you need more than one ratio. Okay. And then next one, there's diversification of entities. Okay, so diversification of entities means a company. Okay, when you want to compare, you have to compare between the same company. The same company in the same industry. Okay, so you might have already heard about this one. When you want to compare, you have to compare between orange and orange, or apple to apple. You cannot compare between orange and apple. They are not the same thing. But now, one company is not specializing in one thing only. Okay, now a lot of companies already diversified. They are having business in a lot of industries. So they might have a shopping mall. They might have property. They might have business in other industry as well. So it is when you want to compare, it's like now one company is still an apple, but another company is apple, but then apple as well as orange and also durian and something like that. Okay, one company is really diversifying. Okay, they are still in the same industry, but then they have branches of things with other industry as well. So it's hard to decide because of that one. Okay, and lastly, we have extraordinary events. Okay, this one relates to historical data as well just now. Like I said, we use the financial statement of 2018, 2019 to make a decision about a company. But if we don't look at the extraordinary event that happened in 2020, we might want to say that the company is doing good just because they are doing good in 2019. Okay, but then after analyzing whatever happened, okay, during the lockdown, we might not want to invest, even though the company is doing better in 2019. So we also have to consider the extraordinary events that happen in the company to decide, not only just to look at the financial performance in terms of financial performance. Like I said just now, changing your director can make your company change a lot. Okay, and for example, anything that happened, the viral sensation on the social media now can make your sales increase and can also make your sales decrease. So anything happen, something like that can affect your decision that you want to make for that company, whether you want to invest or not. Okay, so with that, that's all for chapter 1.